So the angel investor, now this is definitely different from investor to investor, but they're usually a high net worth individual, someone who's got money that they want to exchange in exchange for equity in startup businesses, businesses that have potentially high growth potential or have some kind of high value coming along in the future with them. Now, quite often they're retired executives, or they could be retired or fairly advanced entrepreneurs who are looking for a new thing. Quite often, these angel investors are people who've had startups of their own and they've gone through the process of growing those, scaling them, and eventually selling them so that they've now got a big bucket of money that they want to use to invest back into the ecosystem and generally find something that tickles their fancy, something that they can add value to, not just in terms of putting money in. Now, that is just part of the story. The other part of the story is that they are, yeah, looking for those high potential returns at a relatively low entry point. So they don't necessarily have to come in with $30 million to get something going. They could come in much, much earlier in the process. So the cost of entry is much lower. But they like to get in early before things get too big. And so that might mean, quite a few risky adventures they go on to look at various companies that have lots of different kinds of growth potential that may represent different levels of risk. But what differentiates an angel investor perhaps from venture capital and private equity later on is that the angel investor, because they're generally someone who's done this before, like to be able to bring their experience, their expertise, and offer not just money, but support and a little bit of help along the way to help these startups get going. So you could be, say, for instance, you developed an app, you grew that to quite a good size, you walked out and you sold it for $100 million, and now you've got about $20 million of that you're putting into your angel fund, and that angel fund you're going to use to distribute through to investments in various little startups. A million there, 500,000 there, 150,000 there. So what you're essentially doing is taking the proceeds of what you've earned before and looking for new opportunities that you're not building yourself, but you will perhaps become part of the help and support that goes along with that, along with your investment, of course, and a stake in the company, some equity in that business, a percentage of the shares in the future of that business. So they fulfill, I guess, a gap in that process. It goes from money that you might have got from family and friends. So, for instance, your brother has said, "Yeah, I'll go into business with you. Here's $20,000 to get started," and you use that $20,000 up really quickly, and then we have to go and get more money. But you're not quite at the level where institutional investors or venture capital firms will be wanting to see you. So an individual, such as an angel investor, is kind of filling that gap between the family and friends, which is obviously usually less an investment and more of a more of a gift, and the institutional investor who is looking for something that's a little bit further along the road with a lower risk profile and generally looking for something that's a bit more of a sure thing. So that gap then comes part of a journey. So the family and friends might be where it all starts. You hit up the bank of mum and dad to get that initial startup funding to buy a computer and to maybe get a rent and a fit out of a small office. The angel investor then comes in and they do their part of it. Venture capital does their part. And then that's when you look at things like Series A, Series B, and some kind of Series C or something like that. And then at the very end of that journey, you might be selling your company maybe to a private equity firm who will come in, usually take a controlling interest and add operational support to get that thing really profitable to either then sell on themselves or perhaps go with you forward and you sell it together. Or you buy them back out of it, whatever the journey happens to be. It's very different in all different situations. So if we look at that as a journey, then the family and friends part is kind of the very beginning. That first, couple of $1,000 you might have needed to buy a computer or perhaps, a bit of loan from their mortgage equity to get you into your first shop front. But then the angel investor is the next step where they go, well, okay, I've got, a bit more money here to throw into this to help you to develop the idea that you're trying to get going. Venture capital then is that next step where things get a bit more serious. You're now out of that sort of very risky, very small venture into something that is potentially now growing much quicker. There's a bit more certainty. There's a bit of momentum. You might have gained, say, your first customer, or you might have got your, made your first $100,000, or you've at least developed your product so it's out there in the marketplace. And then it leads then to the growth, to the scaling up. So that's when you get into Series A, Series B, Series C in some cases, where you are very much an established business, but you're still not yet making the kind of profits that are going to be able to fund the future growth that you're trying to get to, which gets you from $100 million of revenue to $1 billion of revenue. You need much more investment from outside sources to do that. Private equity then is the end of the journey, where, for instance, they may come in, and this is not the story for everybody. Private equity is not the story for most, but it could be that your business gets to a certain point. You say, okay, I want out. And a private equity firm may come in to be able to add their expertise to make that $1 billion company into a $20 billion company. And their return on investment could be 20 times what their original investment may have been. Now, by that time, the angel investors are usually well and truly out. And even by private equity time, you as a founder may be out as well. So, in the very early stage of this whole investment life cycle, there's not really a live product yet. Generally, it's more of a concept. You definitely don't have a paying customer. There's not really any revenue coming in. It's just usually a concept whereby you've got an idea that sounds really good on paper. You pitched it well. It's maybe a few drawings on a whiteboard or on the back of a napkin. But the idea is that good that someone who is an angel investor who may have done their own startup before thinks there's some value in that. Now, this is very different to venture capital, which is generally looking for some kind of momentum that shows you've got that first customer, you've got that first piece of revenue, you've got something going rather than, just the back of a napkin. Now, we all hear stories about, the back of the napkin kind of thing where someone walks into a venture capital firm, draws a few squiggles on a whiteboard and walks out with, $20 million. Now, that is by far definitely not the general way of working with capital. This is the exception rather than the rule, and it's a lot of that stuff is very much from the lens of Shark Tank and that sort of thing, where it's creating an artificial environment where these things are seemingly happening. But there's a whole lot of stuff that goes on behind that. Even in Shark Tank, you would probably not understand that most of those deals that happen on Shark Tank never actually happen, or in Dragon's Den or programs like that. The deals never happen because a whole due diligence process has to happen in the background. Everything has to be checked. Because I could go into an office, I could draw on some whiteboards, I could go on a television show and say anything that they want to hear. And then they start circling, and there's blood in the water, and they really want to throw money at me. But I haven't had to prove anything yet until that goes into the background. So at this very early stage, where the risk is quite high, where there's not necessarily any actual product, well, it's very important to go into that due diligence. Now, a bit more about that later, but why are these angel investors important? Well, like we said, they fill that gap between the family and friends investment or gifting of money through to when venture capital kicks in. The angels tend to make it more attractive for startups to begin because it's not quite to the same degree of investment thesis or dogmatic approaches to investment, or the risk aversion that comes with quite a lot of startup involved venture capital firms or private equity firms. Private equity is not really looking at a lot of risk. Venture capital looks at a reduced risk. Angel investors may be willing to accept a bit more risk because they're coming very early. So the potential returns are absolutely massive, but the potential losses also could be equally massive. But what they do is provide that point where you're not going to get a bank loan for this thing. No bank's going to talk to you because you don't have anything for them to leverage against if your business doesn't work. But it could be that you're not quite at the level where an institutional company like a venture capital firm will really go near you. Angel investors then come into that area where they make it just a little bit easier for a startup to go, okay, we could seek investment that isn't quite as full on as venture capital just to get us going in this first year or two. And that makes it much more attractive for them to come into the market. So they do provide some kind of incentive for those startups that are not quite sure where this thing's going to go, of whether to start up or not. What also tends to come with angel investment too is a lot of mentorship, introductions to the networks, and some of the insights that come from their own experience as either investors who they've done this many times before, or comes from whether they have they've built their own startup, they've gone from ideation through to exit in that process before. Yeah, why is that important? Well, you're not necessarily going to always get that from all venture capital firms or all private equity firms. The private equity firms may install their own operation support in there to pretty much take over the operations of the business. Venture capital firms may only be interested in, for instance, being an investor and not really providing mentorship or introductions or networking. Now, that's very different. You tend to find that some of the smaller firms are a little bit more hands-on, and they'll help you to be introduced to the right people to help you get things done. They may have networks of outsourced support or software developers or something like that that they can bring you in on. Depends again on the individual venture capital firm. But in the case of your angels, they tend to be much more hands-on. They'll provide that mentorship. They're very interested in that part of it. They're not just a blind investor. They come in as a more active partner in the business with you. Where they also fulfill in is that they tend to provide a pathway to much more diverse founders. This is just simply in when we look at places like Silicon Valley, where there's tends to have been a criticism in the past where venture capital only tends to go into the middle-aged or the young white male, and then others from other backgrounds don't tend to get looked at because they're not part of some boys club. Now, that's certainly not been as bad in Australia as it's been, say, in Silicon Valley, but it's still there. So the idea of the angel investor is that they may be a successfully diverse person themselves and successfully grown a startup and been able to scale it and sell it and move on and then become an investor. But they then have their own thesis, their own approach, which might include having more diverse female founders or people of color or people who come from different backgrounds like LGBTIQA plus groups, whatever it is that they might be able to bring a bit more diversity into the capital investment business that may not exist quite so far down the chain as private equity and venture capital, although these days I know that the ESG, the the environmental and social and governance requirements of companies these days has certainly come on board with venture capital firms and with private equity firms. And there's quite a strong push with a good chunk of the firms in Australia, at least, agreeing to ESG requirements and ESG minimums to say that diversity is something they are aiming for, as well as sustainability and all the other good things for both people and for the planet. And they also contribute to new forms of economic growth. Now, here in the Northern Territory, we don't have a very diversified economy. We have a very economy is based very heavily upon resources, resource extraction, fly in, fly out workers. Pretty much, if it grows in dirt or it can be dug up from dirt, that seems to be where most of our economic activity happens outside of government administration. Now, if you want to come along and start a new advanced manufacturing project in the Northern Territory, that may be something that initially gets kicked off with some help from an angel investor, where it may not be as likely to come from a bank investment or a private equity firm, because private equity firms don't really fund those new things. They'll tend to say, okay, we're already established in South Australia. We want to expand into the Northern Territory. That might be what a private equity firm would do. Venture capital then might go, yes, we do actually want to help establish this, but we want to see some kind of momentum first, not coming off from the very, very, very beginning. Depends again on the venture capital firms. Some of them will do this, some of them will not. But angel investors tend to help to fund very new economic activity in a new place. So for instance, if someone was trying to build an advanced material that's used for housing, that may not be something that a private equity firm would touch or a bank would touch, but it may be able to be a combination of, say, a government grant to help get things off the ground, plus an angel investor coming in and helping to get that thing moving. Now, they also tend to, these angels, enter into some risky adventures that others won't. A bank will not back a risky venture, or if they do, they'll want a third to half of the investment backed by you. So you'd have to provide, $500,000 worth of investment yourself, and they might come in and give you another half. So that sort of thing is a lot more leveraged against the kind of risk you're willing to take. Now, again, that's not going to happen in every case, and I'm certainly not a financial advisor, so that's something you'd have to discuss with a bank yourself. But you'll find that the angel investors, because they've been through risk themselves, tend to be not so much risk averse, and certainly not so much uh, wanting to jump in, with both feet into a fire. They tend to have some risk aversion, or at least some risk moderation they want to put in there. But they tend to look at the things that others may not look at, things that don't look like they are a sure thing, but they look like they're a great opportunity and could really work. An angel investor, because of the lower amount of money they're coming into it with, may find that that's risk worth taking in order for the promise of a greater return down the track. So how does this all work? How does this whole angel investment thing work? Now, it's going to work in different ways in different places, but this is how we've seen it kind of work in Australia and to a lesser degree in the US as well. You got things like this idea that there's free money everywhere, that everyone's going to give you free money. And this is not the case at all. It's not like there's money going to rain down from the heavens that's you don't have any sort of responsibility for or any sort of requirement to pay back. That's certainly not what it is. It's not a government grant. It's nothing like that. Angels are looking for opportunities all the time. And those opportunities are not, again, free money. It's not someone giving you money and there's nothing going in return. They're looking for a return on investment. They're looking for, some way of making extra money from the money they're investing. So there's going to be a period where they're going to look at you and actually go, is this for real? Now, there's been many, many cases in venture capital, angel investment of businesses that were just not worth backing. WeWork is one example. You can look into other American examples like Theranos, for instance, which was just an absolute disaster of lies and deceit. But angels are actively looking for opportunities. They're not just sitting there waiting for things to come to them. They're usually, quite motivated because they've had to do a startup themselves before. So they're looking for those opportunities. What they're also then doing is relying on those opportunities coming to them through their networks. So that means going to networking events, having great relationships with other angel investors who that quite often they'll come in and go, look, I'm going to pass on this because it doesn't fit our investment thesis, but we're thinking that you might suit this better. So they might hand that over to you. So that network for them is incredibly important because that's where their trusted referrals will come from. And maybe if they're not part of a network, then they're kind of a lone wolf on their own. But usually these groups, they tend to be part of quite expansive networks. And they will rely mostly on their networks for leads. Those leads will come in from that network. So that's the idea that the leads will come from people who they trust, the people who are also doing the thing that they're doing. It's quite a collaborative way. It's not just everyone looking out for themselves and treating every other investor as a potential competitor for opportunities. While there is a slice of that, it's also that it's a lot more collaborative. So for instance, I might come in like this investment needs $5 million. I'm going to come in with 1 million. How about you guys all throw in 1 million and 5 of us will go in and all own a piece of this? So there's a lot of collaboration and co-investment that happens as well. And that happens in venture capital as well. What they'll do is these angels will talk to many, many people and explore a few of those opportunities. So they'll talk to many. They'll maybe sit through, 100 pitches a year, but they may only go into any sort of depth of exploration of maybe 20. And they'll invest in maybe 2 in a year. It's not something which they go, everybody they talk to, they shake hands with, they're going to invest in. It doesn't quite work like that. Not everything is going to make it through an angel raising round. So they'll talk to a lot of people. It's like a funnel, right? Talk to a lot of people, explore a few things, and then invest in just a couple of those. At the bottom, an opportunity drops out and gets invested into. They're looking for very specific things in the opportunity. So if you have a very clear value proposition, you know what the value is you're bringing to a customer. You know what their problem is, you know how to solve it, and you're solving it better than anyone else, or you're at least solving it at a lower cost than anyone else, or in an easier way than anyone else. Also, a scalable business model. There's no use having a very, very tiny little niche of people that you're going to serve and then expecting those people to pay $1 million each for your product. That's a high risk. The fewer the customers, the higher the price of those customers, the greater the risk for an angel investor. So they will tend to look at things that they think, can be serving a lot of people, but doing a really good job of serving those people. And then there's also the idea that you and your team, if there's a team involved or it's just you, that you're capable, you're motivated, you're talented. The last thing they want to do is have to have arguments with a founder who's lazy, who doesn't really want to do the work, but is expecting everyone else to do the work for them. So a capable, motivated, talented team becomes, something that it's very attractive to partner with. If there's a whole team of people who are just absolutely sold out on making this thing work, that inspires a lot more confidence than an angel. And there's the pitch. This is the part where you, as a founder, will come forward and bring forward what it is the opportunity is for this person to invest in. And a pitch is kind of like the Shark Tank thing, right? Here's what I'm doing. Here's how it serves someone. Here's my target market. Here's how it can expand. And here's the scalability of it. And this is what I'm asking for. I'm asking for this much money, for this much equity of my business, this much of a share of the business. That pitch then is going to be done so that the investor can understand what your business is about, get a really solid understanding about it. If they walk out of that meeting and have no idea what you're talking about or no idea what the opportunity is, then you've failed, right? If you if you haven't adequately given them what they need to identify what the risks are, so if you're trying to hide risks over there where no one's looking, trust me, they're going to find these risks because they are trained, they're experiencing at finding these things. So make sure you're either honest about the risks or you make it so that they can very easily identify them for themselves. What they're trying to do by meeting with you, hearing your pitch, is to get a better idea of what the opportunity is. Is it a benefit? Is it something that's an opportunity, or is it too great a risk? What is the business? I'm not in the business. How do I make an understanding of the business? How are you going to serve your customers, and how are you going to do that in a way that's much greater than anybody else? And then a process called due diligence happens. And we all do due diligence in life before we buy things, before we go into arrangements. And it's so that, that the investor can look at the fundamentals of your business. Is it a financially viable model? Is there a legal standing, or are there legal issues they have to look at? Are there trademarks you're infringing? Is there a patent that you're infringing? And what is the real market potential? We can say anything we like in a pitch, but when they do their research and go, well, actually, they told us there's potentially 2 million customers. We're looking at this and thinking there's only really about 25,000. You might have a problem. I was in a pitch, just a month ago where this was the case, where someone had a very overinflated opinion of who the customer could be for this product. And when we looked at it and went, you want to charge this per month, and for this many people, the numbers didn't add up. So whilst, in a lot of pitches, we'll see some interesting numbers that don't add up, we go ahead and we go and do the numbers ourselves and work it out and go, maybe we need to pass on this one. This does take time, though. And for those who are not patient founders who understand that it's not up to an angel to come in and save them, they're going to understand that this could take a couple of months. It can be as quick as a week if there's a very uncomplicated environment to walk into and there's no things that need to be sorted out or having to go through a whole lot of different levels of negotiation. This stuff does take time. So if you're not patient and you're just going, I need money now because otherwise this company's going to collapse, you're not really giving that angel investor much of a reason to want to invest in you. The next thing is the term sheet. So there'll be this matches basically what the founder's concerns are and what they want to get out of it and what the investor wants to get out of it. So it's where you agree to the valuation of the company, what your rights are as an investor, what the impact is on the founder, what kind of equity share is given for that money, and also what is the money that's going to be exchanged. This is not a legal document; it's non-binding. It's a guide that lawyers use to draw up the final agreements and the final documents. And this is as well going to take time. So you can't get this to happen in a couple of days. It's going to take time because the investor has a whole team of people behind them. They may be an individual investor, but they still have a lawyer. They still have an accountant. They still have people that they have to trust with this. And in amongst all this, there may be things like non-disclosure agreements, which is usually the first step that it takes, that someone agrees they're not going to talk about this to others. There's not going to be a competition thing. We're not going to steal your idea, any of that kind of thing. So Where are these mythical creatures, these angels, these unicorn type creatures who are got all this money to be able to invest into companies? Well, where you find them is tends to be in networks, right? They're in networks such as the Sydney Angels, Melbourne Angels, South Australia's Southern Angels, the Brisbane Angels out of Queensland, Perth Angels in WA, angel networks all around the place. There's a small angel network here where I am in the Northern Territory as well, operated through the Darwin Innovation Hub. So there's angel networks absolutely everywhere you probably had no idea actually existed. And they are there to connect all these angel investors with each other. Remember, I said that they're quite collaborative, they like to work together. And what happens is a lot of founders will then be part of these networks and be pitching at regular events or are introduced to these networks so that then the networks can work amongst themselves to find appropriate investors for that. Now, this all comes down to the appetite of individual angels, what their investment theses are, what their preferences are. Are they a sustainability play? Are they an impact investor? Are they someone who's just looking for tech? Are they someone who's looking for biotech or for advanced manufacturing? Whatever they're looking for, these networks tend to deliver it. So this is where you're going to find the people in all these different places.